Welcome to another edition of Expert Talks by Kalkine Media, and today's Executive Corner will feature esteemed Kalkine Media client, Portal Asset Management, a leading digital fund investment firm. Portal's consensus is that historical data indicates digital assets to be the fourth superclass of financial instruments. And Mark Witten, the CIO, will share insights on the current economic climate and introduce Portal's new Radiance Multi-Strategy Hedge Fund. With Mark's close to 20 years experience in equity analysis and hedge fund management, this should be an interesting show. So introducing to you, Mark Witten, CIO at Portal Asset Management. Welcome to the show, Mark.
Thank you. Thank you very much for having me.
So Mark, please fill us in. Radiance has chosen to position itself as a thematic, fundamental focused fund. Why is that?
So Sage, I think when we've been running the Portal Digital Fund, which is a fund of hedge funds for the past, call it 2.5 years. And we noticed when we looked at all the funds available that were out there, most of them really were positioned in the US. We noticed that most of them either had a very strong tech focus or were sort of market neutral, running quantitative algorithms, things like that. And they were quantitatively focused. But there weren't many funds out there that were bringing together very strong tech understanding, industry knowledge and understanding, and very strong fund management insights as well, and expertise. A lot of the funds were also focused on trading the most liquid instruments, traditionally Bitcoin, Ethereum, and futures. But when we looked at how much was invested in VC, private equity, it was north of $30 billion last year. Quarter one this year, they've recorded $12.1 billion in additional investment. The likes of Galaxy, Pantera, Andreessen Horowitz, and others have continued to raise billion-dollar funds. And there's a lead and lag between when that money is invested and the projects are then pulled together in terms of developers and teams, and in the second and third and fourth round of funding. So there's a 12 to 18 month lag. And what we see is that there's a lot of new tokens, a lot of new product that'll be coming to market over the next 6 to 12 months. And I think that'll continue to increase. And funds that have been focused from a more quantitative point of view on the most liquid are going to miss out on what's coming from a thematic point of view in terms of Web 3.0, gaming, fan reward programs, and that sort of thing. And you need to have people, the likes of Nitin Gawa in our investment committee, and Matt Spoke, and Jules Chen, who's now in the US, was based in Sydney. She's now in the US at a couple of conferences like the Bitcoin conference recently, and Permissionless, soon to be held in Texas, in Austin, that have a deep understanding of this, and therefore can look at these new tokens, can look at these new thematic products, these new thematic tokens, which trade more like securities rather than cryptocurrencies, and really get an in-depth understanding as to what could be the new sort of unicorns. So we wanted to position ourselves thematically in the right themes that are coming down the pipe. You had the summer of DeFi in 2020, then you had NFTs in 2021, and although the markets felt a bit less enthusiastic, should we say, over the last few months with interest rate and inflation expectations and the conflict in the Ukraine, the underlying news flow in crypto is still really, really positive. But to take advantage of that, you need to be positioned for the right thematics, and then also have an understanding fundamentally how to value those tokens, how to take into account operational risk, management, the social construct around them, the market they're addressing, the business model. And I think we've tried to bring those elements together, both from the tech guys as well as myself with my fund management experience.
Thank you so much. And it's an interesting time to talk to you as well, as Australia has just approved its second ETF for Bitcoin as well. So why do you think America is holding back on doing a spot ETF? Do you have any insights to share on that?
So I think, unfortunately, the US has had a lot of political turmoil, should we say, for the past few years. And against it, the SEC has been kind of trying to deal with this hot potato and kicking it back and forth. The infrastructure bill created a lot of awareness in the middle of last year, and it coincided with China banning the Bitcoin miners in April, May, and into June. There was a lot of concern around regulatory overreach. And then recently, the White House issued a statement which said that crypto is too big to ignore. It is mainstream. They're not going to be regulating the technology as such, or the developers or the miners. They're going to be looking at regulating the industry players, which is the right way to do it, to create the right framework and rules for the playing field, and then let the entrepreneurs and developers get on and do what they do best, which is compete. So I think that there's kind of a reticence more from a political point of view. I don't think, if I look at the drive from investors, the likes of really big and well-established and respectable institutions like ARK Capital with Kathy Wood, like Brevin Howard, Ray Dalio's Bridgewater, they're all entering the space. And now there's how do you fulfill the need from a more retail perspective, and also provide compliance for more institutional players? So I do think it will come at some point, but I think there's just concerns around custody, potential liquidity, because the amount of capital in the US that I believe is looking to flow into the sector, it's not sort of in the billions. I believe it's in the hundreds of billions. It's, as an alternative, Bitcoin has hardly experienced the same rate of adoption that you have with the likes of gold and precious metals. I mean, the gold market cap is, I think, 12 trillion currently. And the entire crypto market cap and digital asset market cap is 2. I think those two could quite easily converge over the next few years, and that will be driven by inflows into ETFs, which then will be, forced to buy the actual underlying spot in some percentage, and that'll be a big driver.
Thank you, Mark. And interesting what you said earlier about trading digital assets more like securities for some of these businesses, such as T0, the exchange that just recently got listed on the New York Stock Exchange. They're a security token. Can you tell us more about why you believe, or what you believe differentiates the Radiance Multi-Strategy Hedge Fund in this space, please?
Yeah, I think it's exactly to that point, Sage, that we, as investment managers, and having invested in various asset classes, including, real estate, equities, emerging market equities, and then tech, high growth, commodities, and real businesses. Before this, I set up a VC fund for a Melbourne-based family office that bought into actual virtual reality gaming businesses and influencer businesses. The bottom line is, you need to understand, how is this project going to generate cash? How's it going to generate profitability? So you have, the likes of layer ones and cryptocurrencies, which are, therefore they behave. There's no real underlying backing. It's a currency, just like the fiat currencies of the world today, are based. They don't have any underlying, they're not backed by gold. They're not backed by silver. They're backed by essentially the tax base and the faith in those governments. But DeFi, and to an extent, some of the NFTs and the collateralized debt solutions, the gamification that'll be, the gaming businesses that'll be running on top of the blockchain, the NFT fan tokens, the likes of Chili's that has just signed, Lionel Messi, who's got, 500 million followers globally. Those are going to be monetized. There's going to be a real business solution there. They're addressing a need in the market. Often it's very similar to what we've seen in traditional markets, and banks have been fulfilling that role, but banks are centralized, they're quite controlling. There's been a lot of bank overreach, and I think investors have taken notes of that. So in terms of, how we see ourselves and what makes us different is, we're not investing in anything that's sort of hype. We have a very, very solid and rigorous investment process that looks at both the macro and thematic, where the world is moving towards and what themes are gathering momentum, what the VC and private equity guys are investing in. And then we have, a quantitative process that helps us shift through opportunities. It's kind of like a dashboard that has both, what we look at the tokenomics of both value and momentum and quality to understand, what stands out and kind of answers the questions that we would ask ourselves in terms of what's the total value locked, what's the ROI. But then what we also do is we tend to be sort of an inch wide and a mile deep on the tokens we invest in. We do a real deep dive fundamental analysis. We download the white paper, we try and talk with management, we tap into the community. What do the developers think? We look at the actual technology. What need is it addressing? What type of protocol is it sitting on? We put all that together, and then once we have all that information into a trade proposal which collates and summarizes that, we then that's the research, that's the investment research, that's the science. Then there's the art of sort of portfolio construction and risk management, which is based more on liquidity, operational risk flows, portfolio tilts, that sort of thing, yield versus growth. That's kind of another process that combines the best of what we believe is best in class tokens and securities, and then really solid understanding of how to price and manage risk and trade. And I think that differentiates us from a lot of our competitors that are either very tech focused or very quant orientated. There aren't many fund managers out there that are bringing together all these disciplines. We have three sort of champions, should we call them, in our fund. Nitin Gawa, based in Austin, Texas, who's just left IBM after 21 years as a director. They set up their blockchain labs. He's now moved to State Street as a director there, and he's driving the thematic research and understanding where things are going with the technology and the regulation thereof. And then we have Petros Zefos, who's a data scientist, also with IBM, consulting with us, who has a PhD in stats and quants and is building these models and this AI and this computer learning and trying to backtest and understand what is really driving these tokens, because it's not established yet what the tokenomics are. It's not like equities where there's a headline earnings per share number and a PE and a growth for the industry. Like, those things are still being discovered. We're still formulating that. And then I'm driving the fundamental research, almost like stock picking, with Jules Chen and the rest of the team. So I think that we're bringing together disciplines that you don't really find in the industry at the moment, or you do, but it's rare.
Well, sounds like a winning combination, what you've explained there for us. Thank you so much. Now, just one more thing about the Radiance Hedge Fund, with the focus on fundamental analysis rather than being quantitatively driven. You mentioned there that gold has a market cap of about 12 trillion, I think you said, and the digital assets is closer to about 2 trillion at the moment, if I heard you correctly. How does volume play out in the analysis? Could you help us understand it a little better, please?
Sure. No, it's a very important question, because it's one thing having a good investment idea, having the right hypothesis, but then it's another thing being able to execute successfully on that. You can often get into a trade and then you might not be able to get out of it. And that to me is real risk, the risk of permanent capital loss, being stuck in something which you just can't exit. So there is still a lack of volume, particularly when times are turbulent, or when there's a bit of, as I said, there's a lack of enthusiasm. People are concerned around where growth assets will be, with inflation worries and interest rate expectations rising. But at the same time, if you know how to price that and say, well, look, we're going to allocate a very small amount of capital where overall it shouldn't have a massive effect on the portfolio if it's binary and goes to zero. But, if it does well, we could see a 1,000% rise, or in the case of Solana over the past 4 years, a 28,000% rise. Mm-hmm. I think you need to balance your liquidity. So in other words, you need to have, as our fund does, we have a barbell strategy where we have roughly 70% of the fund's assets are in the top 25 ideas out of the top 100 crypto and DeFi tokens and digital asset tokens. So those are highly liquid. And we know we could probably trade comfortably, north of $5 million in and out of those tokens in a 24-hour period without leaving any sort of footprint. So you could easily have $100 million allocated there with no liquidity constraints. The other 30% of the fund, the other side of the barbell, is invested in much less liquid tokens. They're also listed, but they're still nascent. They're still gaining acceptance, and those are going to be the next, what we perceive be the next unicorns that are going to enter the top, the top 20 at some point. And there you do have to be careful in terms of capital allocation, because volume will play a big part in getting, price manipulation, but also in actual risk management. And that's the difference between volatility and risk. The volatility gives you opportunity to buy what you like, even in the listed, the more liquid large cap tokens. Whereas risk is getting stuck in the, that's why I think VC represents a high level of risk. The returns can be great, but you're also a lot of those projects are not going to survive their first year or two in the market.
Yes, there's little historical data to back it up, I suppose. Thank you, Mark. So there are now expectations, perhaps, with the high inflation and the war in Russia, the geopolitical factors affecting the markets, causing maybe a bearish swoop, taking over the traditional economic markets. How do you see this impacting the crypto sector, please?
German PPI came in at 30% yesterday. That's a big concern. It's the highest it's ever been, I think, since pre-war Germany or post-war Germany. Inflation in the US is also rampant, and the momentum is to the upside because you have supply chain disruptions now in Shanghai, places like Singapore, etc. And you have more cost push coming through from fertilizer, potentially fuel at some point. So the Fed is kind of struggling to regain credibility, I think, in that they were underestimating inflation and talking it down, and now all of a sudden it's a real problem. And obviously you have geopolitical risk, and it's sad to see that there's no attempt to try and de-escalate the situation, but rather continuing funding of further arms packages being sent by many countries, which is only going to make things worse and drag it out longer. You could have another Syria on your hands. And the challenge is that the Ukraine and Russia represent a large amount of wheat, barley, phosphates, fertilizers, things like that, as well as oil and gas. So you could see cost pressures picking through. I've always been amazed though at how quickly the world can adapt. The Saudis can easily increase oil production, as can the Venezuelans, as can the Nigerians. There are other places in the world, whether it be in India, Africa, South America, that can increase food and fuel production, crop production pretty quickly. So I think the inflation problem is one that could easily be sorted out if we had strong political leadership globally. I think in terms of risk assets, I believe that there's sort of quite a big backlash underway at the moment against what I would call big tech. You saw Netflix down 38% at the open yesterday. Many of the subscribers are moving on. Disney's having the same challenges. So I think the short tech and short banks, which have had way too much monopolistic control, is quite a good trade relative to long crypto and DeFi. The challenge is that these assets are tied together as growth assets. People look at their portfolios and they go, well, I'm in real estate, it's illiquid, but it's doing really well. I personally feel there could be a bit of a bubble there, and they look at fixed income and they go, well, rates are going up, that's for certain, so you don't want to be there. And then you go, well, equities, tech is on the way down, but there is some value in some of the industrials as the world starts coming to life again, some of the tourism and consumer driven and food staples and things like that. But it's really in alternatives where I think we could see a big shift, because you might have X amount, 5%, 8% as a family office or as a small institution allocated to alternatives. In the case of hedge funds, private equity, VC, gold, precious metals, and crypto falls into that bucket. And it doesn't take a lot to shift your portfolio from 5% in gold and precious metals to 3% and allocating that towards crypto. So I do believe we'll continue seeing a decoupling, particularly when people start realizing there's real business cases here. Ethereum generated, if my memory serves me correctly, I think they generated $12 or $13 billion in fees last year. I stand to be corrected, but I know it was pretty much in line with what Walmart generated in free cash. And that's a massive amount of money. You've got to start thinking, well, there's real business cases here and there's real fees. So, the short answer to your question is yes, we'll see a lot of volatility in the short term, but longer term, the structural bull market for the space is firmly intact. And how you know that is not because, you look at the market, it's what the lead steers, as I call them, what VC and private equity, which generally have to do a lot more work because they get locked in, once they start funding a project, they're in for 5 to 7 years. So they do a lot more due diligence on each of the tokens and the projects they invest in. They're telling us, look, there's a lot of money being invested, and it's not small amounts of money. I think this year, last year we saw 30 billion of VC. My personal feeling is this year you will see 60 easily. And think about that wave of product coming through, and then you've got a wave of liquidity coming in from new funds and new investors and so on. So the market cap can only go from 2 trillion. It can only keep going. I mean, I don't know if Bitcoin will go up tenfold, but I do think it'll go up. But I think that you'll see a lot more new opportunities and newer tokens with, representing real business behind it.
Yes, absolutely. And now the space is opening up to the people that aren't necessarily computer science background investors. And there's been a huge uptake of Chivo wallets. I think there's been 80 million new wallets over the last 6 to 8 months. And that was 100,000 just, middle of last year. So that's a huge uptake. In many countries, or maybe 3 or 4 countries, are now using Bitcoin as legal tender as well. These are all interesting factors adding to the long-term prospects. Mark, where do you see the space in the next 3 to 5 years, please?
Well, I think what you just said is very much an indication of investor uptake, in that even in times of stress, you see continued growth in wallets. In fact, my personal opinion is the quarter or the end of 2021 and the first quarter of 2022 will be, when we look back in a few years, will be the definitive turning point where investors were actually almost forced to invest in crypto. We saw some very interesting things play out, particularly in Canada, with GoFundMe accounts being frozen, people's personal bank accounts being frozen. What's happened in the Ukraine, the tragedy that's unfolding, you've seen many people, Russians, having their accounts and assets frozen. So people are starting to realize the money in the bank is not really yours. It's the bank's. And if the government decides for whatever reason they don't want to give it to you, they're just not going to. That's been a reality for people in Cyprus in 2014, 2015, when they basically had their funding taken. And I think that's probably the first, one of the first indications of, where things are going. The SEC, so people are looking at ways of preserving their wealth, having ways to transport their wealth, having ways to protect their wealth, because crypto is different. Whoever holds the keys controls the crypto. You don't owe anyone anything, and no one owes you anything. You hold it, it's yours. It's like having a bar of gold in your pocket. The second thing, though, from my perspective, in terms of where it's going, is that we've just had way too much almost monopolistic control by big tech, big banks, and so on. And you're seeing all these, a lot of them, whether it's big pharma, big tech, and big banks, their equity prices are tanking. And you've got to wonder, why is that? Like Facebook's dropped out of the top 10, or metaverse, as they like to call themselves now. They had the great idea of charging developers 50% or 47% or whatever they generated, which is not going to happen. So Web 3.0 is the big game changer here, because Web 3.0 means you own what you've written, you generating wealth for yourself. So as an entrepreneur, how many entrepreneurs are there out there, particularly in more economically challenged countries, that are very smart, very hungry, very driven, have other part-time ways to survive, and in their spare time are building these businesses that are just firing shots continuously? And at some point, I think many of them are going to start gaining traction and starting creating these little ecosystems that slowly start, pulling capital and pulling funds and flows away from some of the bigger platforms. And I think that's where I see things going, is that we're going to have a society that's almost going to be split for a while in two, where I personally believe it's the kind of almost demise of the old system and it's the rise of the new one. And now it's just, people are trying to figure out how this system is going to work and who the players are going to be. But, it's not just because we're in the space. We're in the space because we're so bullish. It's not the other way around. We're not bullish just because we found ourselves here. We spent a lot of time looking at the space. And for me, the space smells a lot like, the hedge fund space, back in 1998, 99, after the collapse of long-term capital management, where you saw hedge funds get regulated and the managers too. And all of a sudden there was this explosion in hedge funds in the early 2000s. And then that happened along with deregulation in the US. So I'm very positive on the space, but I'm not just about the economic returns. I'm positive because I think it's going to change the way business is done and put a lot more power back into developers, consumers. It's going to give them the opportunity to actually generate real wealth for themselves, instead of continuously moving wealth away from Main Street to Wall Street and Silicon Valley. I think that trend is going to be reversed. The pendulum, it always swings too far in one direction and then it starts swinging back. And I think we're seeing that backlash now. It's not me who's making this up. Netflix is down 40%. Besides Tesla, all the other tech stocks are looking at getting getting quite a good hiding, I think, over the next few years.
Yes, very true. Thank you so much. And you mentioned the more democratized internet and social media platforms with the emergence of Web 3.0. What other main trends and themes will you be focusing on investing in?
So personally, considering I have three young kids, and I see how addictive gaming is, and how much they can spend, by mistake. I didn't set settings, and all of a sudden my children had spent $100 in one day on feeding digital animals, digital food, and buying digital shelters, virtual shelters. I think Ready Player One will become a reality in some way. I think our consumption of digital content will be bigger than our consumption of physical content in the future. And it's concerning because we're not psychologically, I think, geared for it just yet. The way our children are growing up is very different to the way we grew up. It's positive. There's positives and negatives. You need to balance it out. So there's roughly 2.5 billion gamers on the planet today. Some are very much part-time, but some are very dedicated. In the East, it's more mobile and sort of portable. In the West, it's more console-driven. But regardless of which form of gaming you like to focus on, those gamers are very early adopters. They're very innovative, and they very much like to trade in, they're happy to trade in virtual currencies and virtual skins and so on. So I think gaming is going to be one of the biggest themes. Whoever unlocks that, and there'll be many, will generate, real wealth. And I think once again, some of the bigger companies, the Sonys, Activision, Blizzard, and so on, we'll see developers moving away from some of those platforms because they can. I think what we haven't seen yet, and where there's massive pent-up demand, is also in client relationship or customer satisfaction or client participation programs, the likes of Chili's. When Cristiano Ronaldo, for argument's sake, joined Juventus, they sold 50 million shirts online in like less than, I think it's 24 hours or something. Wow. And people want to be part of that. People always look for their own tribe. And now you think about luxury goods, and there's a certain appeal for people who want to show their value and show their status online. And that's where NFTs have taken hold. But now you're going to be able to be part of luxury groups, and people have different interests. I'm not interested in luxury, but I do love, I do love sports and Formula One. So I'd be, and that's why it caters for all tastes. And I think when you see that become more of a reality, where people get access to promotions, the ability to decide whether it's their team or their design of some of their products, where they get interaction like that, and where it becomes more emotional and they become part of that community, I think that's going to be that's going to be another massive growth area, and that's fundamentally driven by Web 3.0. So I'd say those are the two big areas. If I had to take, all our capital and invest it into two sectors, it would be gaming and Web 3. There's going to be a lot of failures, but I think if I look at big tech today, I don't think pretty much any of the big tech companies, I think 10 years from now, not even 6 years from now, none of them will be in the top 10. All of them will be in this space, if you ask me. Most of them are already, you become a victim of your own success. That's just how it kind of works. And once you become monopolistic and you become as controlling as the likes of Microsoft and so on, like, people eventually have to push back because there's going to be better ways of doing things.
Yes, exactly. Thank you so much for that. Now, with the boom, we've seen so many crypto millionaires being made in the last 10 or so years. Sometimes it's difficult to understand that it's not too late yet. It's really just the beginning. And the fashion world has really taken up as well, the metaverse and selling online with online shops in the metaverse, and solving some real world problems there with fitting rooms and trying on shoes before you can buy online. So this is changing our behavior. What do you see as the main reason that some people are still crypto naysayers? Is it reluctance to change behavior, or ignorance or fear, perhaps?
Yeah, I think it's a bit of everything that you mentioned. There's obviously a knowledge gap, and language is powerful. It's in every industry has its own sort of native language, and that excludes outsiders unless they're willing to learn that language. So you got to take the time to familiarize yourself with, hot wallets and sharding and all these interesting concepts. And they're actually not that complicated once you get to grips with the language. I think for some people, there's been, negative publicity around it way back when. People had, ideas that crypto was always used for nefarious purposes, which it's actually the opposite. It's a lot more transparent and so on. So there's that. And then I think the patriarchs of family offices and the CIOs of investment companies tend to be, baby boomers, maybe, as in my case, a Generation X, which grew up without technology, and only the internet and mobile phones only really came about when I hit my 20s, back in the 90s, the late 90s. So you had there was a period of adoption, integration, and when we initially just saw infrastructure being rolled out, and the dot-com crash, but nobody was thinking in 2000 about Facebook, about YouTube, about Netflix. I remember Netflix when I was in the UK in 2003 was a place you went to swap DVDs at a train station, on the way out of Waterloo. So that, no one made the jump, and everyone thought, no, the streaming is not going to work because it's too, but that's the point, is that evolution in technology moves slowly, and then it moves very quickly as everyone adopts it. There was a McKinsey report done back in the early 90s when asked about cell phone penetration, and they said that no more than 30% of the US population would ever own a mobile phone. They got it wrong by like a factor of 3,000, right? And that's the point, is we can't predict where it's actually going to land, where we see things unfolding. So it's hard to kind of place your bets, if that's the right way of putting it. But at the same time, that this space is getting a lot of liquidity, momentum. It's also the pedigree of people it's attracting. If you look at some of the headlines, Citibank, they've lost many of their top employees, as has the likes of Goldman Sachs. So you're getting people that are coming in a strong business and financial acumen. You're getting a lot of developers. You're getting a lot of people in emerging markets that kind of don't have many other choices, that are now being forced to enter the space. Getting paid to game and things like that. I do believe, there's pent up demand, whether it's luxury goods, whether it's, gaming and sports teams and rivalries, things like that, whether it's support of, alumni for the universities, like anything and everything can and eventually will become tokenized. And people, to go back to the original point of the question, is why is there naysaying around it? Well, it's because it's new, and anything new is initially, pushed back upon. And then, as people start realizing the applications, they might start embracing it. But remember that, the people that are running family offices and institutions and so on, over the next decade, you're going to see this massive shift in wealth from them to the younger generation who are embracing this. And, it won't be like my children when they're teenagers, which is in the next few years, will have digital wallets. Like, it's just, I'm convinced of it. It's not because I'll encourage them. They're already asking me on Roblox to set up Robux accounts and to give them their allowance in Robux. Like, what is a Robux? What does it buy? It buys gaming. That's it. It doesn't buy anything real. Instead of giving them their allowance and them going to the shop and buying, we used to buy like, sodas and sweets and things like that and play video games standing up. They're now doing it like that's what they want. So, the rates of adoption will increase. The final thing I'd say on that, just to wrap it up, is that regulation has always been a bit of a constraint, because family offices and banks have this, they have a mandate and they kind of have to stick to that, and they can't invest in things that are unregulated. The ASX is approving a Bitcoin fund ETF, and that'll be, to become mainstream. And then the likes of superannuation funds, can you imagine, I don't know, Australian super allocating 0.5% of their capital to a Bitcoin ETF? That's going to be how many billion just from them? Never mind the smaller supers and some of the supposed tech supers, the Telstra supers of the world. So, we've got, I think, the 5th biggest captured pension market in the world, like $2.5 or $2.8 trillion. You don't need a lot of money to take a sector that's $2.5 or $2 trillion in market cap. It's almost like a fire hose to like a ping pong ball at some point. There is going to be this rush of liquidity, and there's not a lot to absorb it.
That's very interesting, Mark. Thank you so much. Just about the central bank digital currencies, how do you think this is going to impact the investment into the sector? And do you see this happening anytime soon in Australia?
So I think central bank digital currencies, first of all, you need to define them, in that they're not cryptocurrencies per se. They're not decentralized. They're centralized by the central bank. It's the same as them issuing the current notes, and we use digital currency already. in the form of credit cards and debit cards, where it's there's no physical paper. So I think it will be positive in that it'll increase usage, increase acceptability, adoption, and that sort of thing. I think it's concerning in that it depends on the jurisdiction you live in. If you live in a place like China with a social credit system and your social credit score drops below a certain level, your spending can be curtailed or even shut off. And that concerns me because, it's very easy to control people when you control their source of funding. You turn people's bank accounts off, they can die if they can't get funding any other way, So that is a concern for me. I think if it's done in the right jurisdictions, Australia being one of them, the likes of, obviously Switzerland and the emerging markets seem to be having a hands-off approach where Bitcoin's becoming legal tender, where you have this, I think it needs to be backed is what I'm getting at. They can't just they can't take the system that's kind of now we're seeing is not working as well as it was, with the likes of CBDCs or fiat currencies now being replaced by CBDCs. And then just start issuing CBDCs in mass, like another monetary policy experiment gone haywire. It needs to be backed, and it needs to be backed by something that's tangible, whether it's gold or Bitcoin or a combination of things, or that's what I think the difference is. If this system, which is the best system we have in terms of capitalism, is showing signs of cracks, whatever comes next, we should improve on that system. And I'm sorry, but I don't think that governments per se have the same amount of insight and understanding from a tech perspective that industry does, and it needs to be more of a joint effort. But ultimately, when you hear those words, I'm from the government and I'm here to help you, you tend to get quite nervous, because history has shown us that hasn't always been the case. They tend to act more in their own interest rather than in ours, particularly financially and so on. So I think it's like anything else. It can be a tool used for great good, for great redistribution of wealth, ease up, a lot of red tape that makes people frustrated, and lower costs for everyone. But it can also be used as a tool for control, and if used incorrectly, for real oppression. And that part is where, I think you need both systems. Like I said earlier about the world splitting between two different sort of camps, you're seeing that too, in that there's some people that are very much want to stick with the decentralized cryptocurrencies and DeFi and securities and Web 3.0. And then you're seeing this kind of the incumbents also saying, we need to control this because, common people are not fit to govern their own affairs. And we're like, well, maybe we should be left to do our own thing. Ultimately, it'll be a hybrid of the two, I think.
Yes, definitely. Yes, it seems that they're two separate paradigms, but yet essentially trying to do the same thing for the world. Yes, a hybrid, similar to what your products do offer people, a hybrid, a traditional financial product in this innovative new digital asset space. So reaching the end of the discussion now, Mark, and DeFi has some roots in artificial intelligence, and there's more AI now being used to fight financial crime in the centralized financial system. Can you see this as a segue from what we were just talking about? Can you see the traditional financial system perhaps working with stablecoins in the future?
Yeah, I think DeFi and AI will make very natural partners. We're seeing what we call the age of augmentation with robotics and artificial intelligence, and AI is becoming a lot smarter and a lot quicker. That the whole singularity horizon is getting much closer. I think it'll be once again there's concerns around this unfettered technology and what it could do. At the same time, it has the ability to do whatever the best human being in that field can do better and at lower cost eventually, and much more precise. So I think the one thing that AI can't do, that I can tell in terms of the Turing test, is ask questions that make sense. In other words, ask questions, and that's where human creativity comes from, is asking questions. Our evolutionary advantage is social. So ultimately the AI is mapping us, but there's an innate curiosity that we have, whereas AI is just programmed to improve a process to the point of perfection. And that's where the two might tie together, in that we could ask the question, well, how do we feed, house, clothe, provide medical care, and so on for the world's population in a much more sustainable manner where there's more equality and more leisure time and so on. And AI could solve those problems for us in a much better way than human beings with emotions such as greed and control and power issues and so on could. I think AI is going to make DeFi a lot smarter. DeFi is already getting smarter, but I think AI is going to make that a lot smarter and quicker. And as I said earlier, I think our online consumption of content, of digital content, will grow a lot faster, as it already has. You know, everyone now has mobile phones and smartphones and watches streaming. And, you know, it wasn't that long ago that Blockbusters as a DVD was a major franchise. It wasn't that long ago that people worked in DVD stores. They're just like, you know, relics now. So I think you've got to be wary of AI in that it's kind of, for what purpose is it set for? Because if you set AI for the opposite, to say, you know, how do we impose control, or how do we, you know, do things that aren't so nice, it'll come up with a solution too. That you're just asking AI the question. Whatever the question is you ask is what's important. And therefore, whoever controls the AI is as important, if not more important, than the AI. And that's, you know, where we see the world at the moment. That's kind of exactly where things are at the moment, is, you know, what kind of questions are we asking as a you know, not only as a species, as a society or a civilization, but just individually. Like, what are we asking ourselves on a constant basis? Like, are we doing this just to continue generating wealth and being, you know, the wealthiest kids in the, you know, on the block? Or are we doing this because we have a sense of contribution? You know, this space, it was born as a backlash to the global financial crisis. That's when Bitcoin came out in 2008. You know, Satoshi Sakamoto invented this years they are. It was a backlash to the GFC and the centralization of banking power and that cartel that had, run up these massive gambling debts because the risk wasn't theirs. That they knew that the banks would get bailed out, because otherwise 40% of currency would go out of circulation if they went bankrupt, which would cause something worse than the Great Depression. No one got prosecuted. They all left and joined the government, unfortunately. And that's where Bitcoin came from. So it's a backlash against all of those things. And the 99% of the world's population is for that. 99% of the world's population is for more equality and diversity and all those good and wonderful things. Most people just want to generate enough wealth to have some good experiences and not have to worry about money. There's only a relatively small amount of people that truly are insatiable in terms of wanting to be billionaires and control the world. It's a very small amount. Most people don't want that. Most people want to have a family, run a business, make some money, go on a beach holiday, that sort of thing. And that's not impossible to do with AI and with this tech, because we can improve supply chains, production. If you had to ask AI, how do we grow these crops with these traits in more abundance, in what climate, and what do they need? And that, it could work out to the millimeter of everything that you need to do it, and do it 10 times better than human beings can currently do it. So it's a double-edged sword like anything else.
Exactly. Yes, I've heard of some very dexterous robots being made to help with fruit picking, which is a very difficult job in some cases. So it does have some real good real-world uses. On the note, though, of AI allowing things to be done faster, quicker, and maybe better than humans, do you think Portal would ever think of using AI in its investment strategy?
Yeah, definitely. We're already engaged in that process with Petros as a data scientist. He's already, we're already building out that AI to improve fitting our performance, or back testing performance and fitting, running simulation, what we call Monte Carlo simulation, which is running, hundreds of thousands, if not millions of iterations of a fund to say, well, what would have been the best fund and when would have been the optimal time to rebalance and so on. Once again, it can only give you answers, not ask the questions. So the questions then are, why did this happen and so on, and to try and investigate that. I think AI will become, like you spoke about, robots taking on repetitive, dangerous or dirty tasks, or, things that can just be automated in any event. I think AI will become as incorporated into our lives as, it already is to an extent, the likes of Siri and so on. But I don't think it can ever replace the fact that, human beings also have a certain amount of intuition. I know there's been tests out there there was a game, not chess, it's a Chinese game that's involved in intuition. I forget the name now, but the machine beat the best in the world at that. And that game is based on intuition. But I do believe that in terms of innovation and creativity, empathy, these sort of things, AI will always be part of an investment process, but there also is going to be, how do we manage risk and return, or the risk that drives return? What are the next things that are coming along? AI can only use what the inputs that go into it are. It's like garbage in, garbage out. Whereas, what's next? Because what's next is not going to be, what's next we believe is gaming and Web3, but what's behind that? What's next after that? And then there's going to be another wave after that and another wave after that. And that's the nice thing about the space. When you spoke a bit earlier about, have they missed the boat, naysayers and so on. It's like, no, I think this is just getting started. Go look at the rates of adoption relative to mobile phones. We have it in our presentation deck. It's like, the amount of adoption, from technology that started things like the washing machine and the television and the motor vehicle. It took many years before it became 100% adopted into a society that could afford it. Smartphones and streaming and that sort of thing became adopted a lot quicker because it was cheaper and easier. Crypto is going to be adopted, I believe, at the same sort of pace. I think, 5 to 10 years from now, no one will be talking about, hot wallets anymore. We won't be we don't talk about going on social media. You just say, that you don't think about it anymore. It's there. It's just part of your life. So I do think that AI is going to play a big part in that. The jury's out. I still don't know whether it'll be good or bad. I think it can be used for both. There'll be certain things that go very, very wrong. And I think there'll be a lot of things that all of a sudden look a lot better. Like AI in medical evaluation, the ability to detect certain, life-threatening illnesses, the ability to perform surgery virtually from afar into places where, I think that's going to be amazing. AI into food production and things like that, I think will be amazing. AI applications in the military, that honestly terrifies me. Military and policing, when I think of AI, social credit systems, that sort of thing, I think that's a recipe for disaster in the wrong hands.
Thank you so much, Mark, for your insights. That was a fantastic fireside chat. And so true, I think the quantum computers can beat people at chess. Is that game you were talking about, AlphaGo, the Asian one?
Yes, that's a documentary, AlphaGo, yes.
Very interesting to see how things will take off in the space. And I think the governments now are a bit more accepting of the innovation and the cost effectiveness of digital payments as well. So very interesting to hear your insights today. Thank you so much.
My pleasure, Sage. It was great chatting to you. I really enjoyed the discussion. If anyone wants to find out more, they know where to reach us.
Excellent. Yes, the Portal Asset Management website is a great resource with some fantastic podcasts as well for more of these excellent fireside chats with the experts from Portal. And if you've just joined us, please watch the full interview on Kalkine Media's YouTube channel and keep watching for more of these expert talks and market insights. Until the next episode, stay apprised and invest wise with Kalkine Media.